So with all that being said, which markets should we be trading? What can we trade? And what is a good popular market to trade? Well, you know what? You can pretty much trade whatever you like within reason. And actually, I say that you can't trade some of the smaller stuff. Sometimes you can. Sometimes there's a really good offering, and you can trade pretty much whatever you like. But you want to trade something that's got the liquidity there. You want to trade something that's got good volume there. You want to trade something that you can understand, really, you're not going to get surprised about with a nasty surprise. You want to trade something that you can do some technical analysis on. You want to trade something that is low cost. You don't want to be paying a big margin, which you would do for small stuff. You kind of want to be trading things that are moving, things that are popular, things that other traders like to get stuck into. So this is kind of a small list. It's in no way definitive, but this is where the big boys tend to play the games, or get involved, should I say. So with Forex, currency pairs, you've got your big four. Debatable about the last one, but anyway, you've got US dollar JPY. You've got which is the US dollar against the Japanese yen. You've got the pound dollar. Nickname of that is cable, which is obviously the British pound against the US dollar. Euro against the US dollar, and then you've got the Aussie dollar against the US dollar. So obviously the US dollar features a lot in those, but quite equally, you could trade the euro against the yen. You could trade the pound against the yen. You could trade the Aussie against the yen. Any of the big economies out there. Europe obviously comes into one currency. Europe, America, Japan, Great Britain, and Australia, and then you can add others into that. You've got other currencies that are equally kind of volatile and equally valid to trade. Swiss franc, Mexican peso. It goes on and on and on. So there are plenty out there, but the big ones are generally anything against the big countries or the big economies against each other. Japan, Australia, Britain, Europe, United States, those kind of big boys. So that's your currency pairs to look at. Commodities wise, crude oil, big one. Everyone's looking at crude oil. That kind of swings in, comes in and out. Some years it's really, really active. Everyone's looking at it very, very, very carefully, and it's moving around. And then some years it just sits there and no one really cares what it's doing. It's kind of funny, but it's always one to watch. I know most traders are watching it, and it's in the news, obviously. And if you dig around in some of the websites and stuff, you're going to find a lot of information on crude oil. Things that affect crude oil, just digressing slightly, are going to be the oil inventories, which come out. Look at the economic calendars to see when those come out. And then you've got OPEC, obviously, are in control of it. Things like war, things like relations with oil producing countries, things like conflict, terrorist attacks in Pacific areas, and that kind of thing, that choke supply or not. Things like innovation, obviously longer term in different fuels. Obviously that's a bit long term now. Commodities, then you've got gold as well. We know what gold's all about. Gold, even though it does have some uses on an industrial level, it's generally seen as a safe haven store of wealth, if you like. Maybe that's becoming less so, but ultimately speaking, generally, and I'm really being generally here, over the years, it is an inversely proportional to risk. So if people are risk averse, they move to gold. If they're risk seeking, they move away from gold. That is a really broad generalization, but that's kind of what happens. But then again, it goes and swings and roundabouts. Again, I remember time trading gold when it's just been really volatile, and it's almost been swinging around like some sort of biotech stock. So these go in ebbs and flows and come in favour and go out of favour. You've got commodities like your soft commodities, like your wheat, your corn. What else we got? You've got things like cotton, orange juice, your meats like your lean hogs, live cattle, and soybeans, and all sorts of different things of commodities. They trade very, very differently, but again, sometimes they trend in a good manner, or if you can get on the end of a trend with them, they sometimes go for a long way, like coffee and sugar. If you look at those charts at your leisure, you can see how they are kind of volatile. Once they get into a trend, it's kind of the underlying fundamentals just keep going because they've got an overproduction or whatever it may be. So they're kind of good things to look at. Spreads are reasonably tight and they're reasonably easy to trade. And then silver, it's just more of a volatile version of gold actually. Silver and platinum, those things tend to move generally with gold, there's a little bit more industrial application with some of the other metals, but generally speaking, the same kind of influences. It's like that risk-seeking or risk-averse thing. But you got to watch out for silver because the contract size is quite big on the underlying, so just be careful that your CFD is still, the small amount, and then also understand that because the underlying contract is reasonably big, you tend to get a bit more volatility there. So just watch out for silver. It can be your best friend or your worst enemy. So look at the indices now. We've got 5 of the big boys here. FTSE 100, obviously we're probably familiar with that. Top 100 companies in the UK. The DAX 30 is the top 30 companies in Germany. Dow 30 is it's not really the top 30. It's allegedly the top 30 companies in the US, but it's a little bit more complicated than that. NASDAQ is 100 of the top tech companies. Again, they're not all tech, but generally speaking, NASDAQ has tech kind of things. So you've got to have your Apple in there, your Amazon and Google and that kind of stuff. And then the Nikkei 225 is your Japanese, 225 companies in Japan. Interesting, you can see how differently they're made up. You've got 100 stocks in the FTSE, 30 in the DAX and the Dow, and then 225 in the Nikkei. And that does affect how they trade, but they are weighted slightly differently. The actual index, the value of the index is made up sometimes. In the instance of the Dow, it's weighted on price, so a high price stock gets more of a priority of how much it affects the index than a lower price stock. And the FTSE 100, it's weighted by market cap. So market cap, as you may well be aware, is just the number of shares in issue multiplied by the value of a share to give you a total market capitalization, which is kind of, I think, is a bit of a fairer way of doing it, right? And the FTSE will give more weighting to a bigger market cap. So if you've got a really big company like BP in there, Vodafone, those kind of things, they're going to have a big influence on the FTSE, whereas the smaller ones are going to have less influence. So if the smaller ones start swinging around, it's not going to move the FTSE as much. You've got BP and Vodafone swinging around, which they generally don't so much. It's going to have less of an impact. And just one thing to point out, guys, is that the constituents change on a regular basis. As they lose value or other companies increase value, there will be certain requirements to stay in or get in or out of the index, and then you'll get that change in of the index. So stocks and shares, I've just again picked a handful here. UK ones, your Tesco, your Vodafone, and your Lloyds. You could have RBS, Admiral, JD Sports, any of the companies that you think of in the UK. Some of the ones that you're familiar with when you're walking around down the streets, Marks and Spencers, and they deal with day-to-day administration like Aviva and what have you, all the way down to ones that you may not have even heard of. But again, any company. Same with the US. You've got obviously the big boys: Apple, Facebook, Google, Amazon, Netflix, Tesla. We could go on. And then Germany, you've got a handful as well. France, you've got a handful. All available. All going to be slightly different costs to trade, slightly different advantages to trading those, disadvantages to trading those. But again, these are the kind of the things that people will trade. It's about finding your style, your niche, and getting involved in what you want to get involved with. You kind of good idea is to trade very, very small to start off with. Pick just a handful of things in the same industry. So you stick with your currencies or your commodities or your indices, just a couple, and just kind of get to know them a bit. Get to know your platform and what have you, and understand what you're doing. Make sure you expose the right amount of risk that you want to be exposed to. You're not taking on too much. You get used to how positions of profit and loss and how things move, and then you kind of progress and pick out things a little bit more advanced as you improve as a trader.